Good afternoon. I'm David Luberoff, Deputy Director of the Joint Center, and it's my pleasure to welcome you to today's talk by Sophia Wedeen on how renters have responded to financial stress during the pandemic. Before I turn things over to Sophia, I have some announcements and a few housekeeping items. The Housing Research Seminar Series will continue in 3 weeks on Friday, November 19th at 12:15, when Sharon Cornelison, a Center postdoctoral fellow, and Alex Hermann, a senior research associate at the center, will report on new research they've been doing examining racial and ethnic differences in COVID's economic impacts. Look as well for information on an event we're planning, tentatively scheduled for Tuesday, November 30th at 4:30 p.m. on some notable locally focused efforts to address the historically large racial homeownership gap. You can find more information about these and other activities on our website, www.jchs.harvard.edu. A couple things to note about today's session. First, closed captioning is available from the menu on your screen. Second, you can use Zoom's Q&A function to ask questions. We'll try to get to as many of those as we can, but I apologize in advance if we don't get to yours. And finally, Sophia's slide deck and a video of today's talk will both be posted on the previous events portion of the center's webpage, probably by early next week. Now let's turn to today's talk. Sophia Wedeen, our speaker, is a research assistant at the center who works on projects related to affordable rental housing as well as residential remodeling activity. She's going to be discussing soon to be published work that she's been doing with Whitney Airgood-Obrycki, Chris Herbert, and Alex Hermann, also our colleagues, assessing COVID's impacts on renters, including how those impacts and the responses to them vary by race, ethnicity, income, and household composition. This work, I want to mention, is being done as part of the Housing Research Collaborative, which is bringing together researchers from the Joint Center, the Urban Institute, NYU's Furman Center, and Berkeley's Turner Center to gather and prepare analyses that policymakers can use as they try to develop effective responses to the pandemic and the ongoing rental housing affordability crisis. Sophia will talk for about 35 minutes, then we'll take questions for 20-25 minutes. We'll wrap things up no later than 1:15 p.m. Sophia, it's all yours.
Thank you very much for that introduction, David. Hopefully you all can see my screen. I guess let me know if you can't. My name is Sophia Wedeen, and I'm a research assistant here at the Joint Center. I want to start by welcoming everyone who's joined us today. And I also want to take this opportunity to thank my co-authors on this project, Whitney Airgood-Obrycki, Chris Herbert, and Alex Hermann. Today, I'm going to share findings from our forthcoming research brief, which is about renter financial stress during the pandemic. Renters were especially hard hit by the pandemic. Millions of renter households lost wages, and a sizable share fell behind on their rent payments. This has raised a lot of questions for us as researchers about what households are doing to make the rent, what financial resources they have at their disposal, and what policy can do to help support renters. In order to understand the many ways the pandemic is impacting housing and affordability, the Joint Center, as David mentioned, has partnered with the Housing Crisis Research Collaborative. The collaborative was launched in response to the pandemic, and it's a joint effort across these 4 research centers to study the impacts of the pandemic in greater detail. You can find more information about the HCRC and a list of their publications on their website. The motivation for the research that I'll be sharing today came from a different paper that we published with the collaborative earlier this year. In that paper, we reviewed evidence from different studies on how the pandemic was affecting renters. We looked at different estimates for how many households were behind on rent and how far behind on rent they were, and how those impacts differed by household demographics. And one of our major findings from that work was that renters were responding to income loss by tapping a really wide range of financial resources. Renters were drawing from their savings, they were taking on debt, they were borrowing from their friends and family. And they were also relying on a lot of policy supports like unemployment insurance and stimulus payments. We concluded from this research that just looking at the number or the share of households behind on rent would really be an underestimate of the full financial toll the pandemic has taken. Renters were doing all kinds of things to compensate for this financial hit. So estimates of rent arrearages by themselves really aren't telling the full story. In order to better understand the full financial toll of the pandemic on households, we need to also examine the resources that renters are deploying to pay the bills. This research, our research, is intended to fill the information gaps that we identified in our last paper. The first question we wanted to answer was, what financial resources households were using to cover their expenses? We wanted to understand the strategies households used to compensate for lost income and how those strategies change when households take a financial hit. Second, we want to know how resource use varied by household demographic characteristics, and in particular by household income and race and ethnicity. We know that lower income households and households of color had higher housing cost burdens going into the pandemic, and they were also more likely to lose work and to fall behind on rent. So we're really interested in unpacking those differential impacts. And finally, we wanted to test the association between using these different resources and falling behind on rent. We wanted to know which strategies are most and least associated with falling behind. These first two research questions we can answer descriptively, and for the third, we also use logistic regression to test the association between spending sources and non-payment for financially distressed renters. Here are some key takeaways from this presentation. If you take away nothing else, we hope that it is this. First of all, we know that really large shares of renter households lost income and fall behind on rent during the pandemic. The second key takeaway is that whether households fell behind on rent or not, they responded to this stress of lost income by using a really wide range of resources to pay the bills. This includes their own resources, their own personal financial resources, as well as policy supports. The third key takeaway is that both the extent of the financial hardship as well as the financial resources that households turn to varied really significantly by income and by race and ethnicity. And because lower income households and households of color were hardest hit by the income loss, they also used a different set of resources to compensate and to try to make the rent. And the final key takeaway is that households behind on rent were much more likely than other households to borrow from friends and family and to use SNAP benefits or food stamps to pay for their expenses. This is a really important point because it highlights the fact that households who were behind on rent really had very few financial resources to draw from. So we aim to answer those three research questions through an analysis of the Household Pulse Survey. I'm going to talk very briefly about why we chose this data source, the sample that we're using, and the key indicators we're examining in order to answer our research questions. The Household Pulse Survey was launched by the Census Bureau in April 2020. Its purpose is to track the ongoing economic and social and health impacts of the pandemic on US households. And there were really a few reasons we chose to focus on the pulse for this research. The first one being the frequency of the survey. The Pulse Survey generally collected data every 2 weeks. This is very frequent and allows us to look at the data at different points in the pandemic. The survey also tracks information in pretty close to real time, so we can pick up changes in the data fairly quickly. And also, the survey has a very large sample size. This sample is really important since it lets us pool responses and also break them down by subgroups. At the same time, the Pulse Survey also has a few limitations that we think are pretty important to acknowledge. The first one being that response rates are fairly low at around 5 or 10%, but the census has published on non-response bias, so we're not too worried about that. And second is that a lot of the key survey questions of interest to us don't cover magnitude. So for example, the survey asks households whether or not they've lost income, but not how much income they've lost. So these are just some important limitations to keep in mind. With all that being said, we decided on a study period using aggregated data collected between August 2020 and March 2021. This time period from August to March was fairly stable in terms of the data, and there wasn't very much week-to-week variation in the indicators that we looked at. And it also captures what we consider the peak of renter financial distress, since at the time there hadn't been much of a labor market recovery, and this was before emergency rental assistance started getting out. We pooled these 15 waves of surveys between August and March, each with an independently drawn sample. In the end, this left us with a sample of around 234,000 renter households, including 113,000 that lost employment income since the start of the pandemic. And as mentioned on the previous slide, the Pulse survey gives us several indicators of financial stress, housing stability, and resource use. So on this slide, you can see the 3 indicators that we looked at for this study. The Pulse survey asks respondents if they've lost income at some point since the start of the pandemic. It also asks renters whether they're currently caught up on their rent or not. And it asks about the financial resources that households are using to manage their expenses in the past week. This includes personal financial resources, such as regular income sources like those received before the pandemic, credit cards or loans, savings, and borrowing from friends or family. And it also includes public supports, including unemployment insurance, stimulus checks, money saved from deferred or forgiven payments, and the Supplemental Nutrition Assistance Program, or SNAP. The next couple of slides provide some really important context about the differential impact this pandemic has had on households during our study period. We know that the pandemic left millions of people out of work and struggling to pay for housing, and renters were really the hardest hit by this financial disruption. The chart on the left here is measuring the share of households that lost income during the pandemic, and it's broken down by tenure. If we take a look at the blue bar on the right of the chart, 42% of US households reported that they had lost income since the start of the pandemic. Renters were more likely to lose employment income than homeowners were, and almost half of renter households lost income. As a result of these income losses, then 12% of households overall reported that they were behind on rent or mortgage. If we look at the right chart, we see that renter households were more likely to fall behind, with 17% of renters reporting that they were behind. Within renters, though, there were also substantial disparities between who lost income and who fell behind on rent. So looking at the blue bars on the left, we see that low and moderate income renters were the most likely of any renters to lose income during the pandemic. 55% of renters earning less than $25,000 lost income, as did 58% of households making between $25,000 and $35,000. This is well above the 42% of households making $75,000 or more who lost income. Now, because these low-income households had less to fall back on, and they already had higher housing cost burdens going into the pandemic, they were a lot more likely to fall behind on rent. The second chart on the right shows the share of renter households that fell behind on their rent payments. We see that although 17% of renter households overall fell behind on rent, those with the highest incomes were less than 3 times as likely to fall behind as those with the lowest incomes. Looking at these same measures, we also found substantial disparities by race and ethnicity. From the chart on the left, we can tell that Hispanic households were the most likely to lose wages, with 63% of Hispanic renter households reporting that they had lost income since the beginning of the pandemic. These disparities are further amplified in the shares of households behind on rent. So again, 17% of renter households overall were behind on rent during this period. But looking at the orange bars, that includes 27% of Black households, 21% of Hispanic households, and 19% of Asian households, all of which were really far above the just 11% of white households who fell behind on rent. So from those last 3 slides, we've learned that the share of renters who fell behind on rent is actually a lot lower than the share that lost income. And in fact, more than half of renters that lost income since the pandemic, or in fact, more than half of renters have lost income since the start of the pandemic, but only about 1 in 6 have actually fallen behind on rent. And that's something that's worth examining. The bar on the left in this chart shows households that didn't lose income during the pandemic. And we see from this that the vast majority of these households continued to pay rent. So 91% of these households kept up with their rent payments, and only 9% fell behind. We don't have a comparable baseline for how many households were behind on rent before the pandemic, or how many are typically behind on rent at any given time. But this shows that most households whose income sources weren't disrupted were able to keep paying rent. Now, the second bar, taking a look at the second bar, this is showing households that lost income. And this is the group that we really want to focus on. And there are two main takeaways from this slide. The first is that the majority of renter households that lost income were still making rent. So 76% were still making rent. This means that one way or another, most of these households are compensating for that financial hit with other resources. And this is a really important group. The second point is that at the same time, nearly a quarter of households that lost income did fall behind on their rent. So this group also took a financial hit, but they weren't able to compensate for it. And as we continue to think about estimating the full impacts of COVID on renters, we're going to focus on both of these groups and the resources that they're using. We know that households that lost income will pretty much by necessity turn to other resources to meet their ongoing expenses, including the rent payments. These resources can include credit cards, savings, or money borrowed from friends or family. Resources like these can be used routinely to accommodate changes in household income. But at the same time, we know that households who reported a loss of income were much more likely to have tapped those other financial resources. This chart shows the extent to which renter households relied on different resources to meet their spending needs. So the blue bars represent households that did not lose income during the pandemic, and the orange bars represent the households that did lose income. This chart is measuring the share of households that used each resource in the past week, and households can select as many of these categories as apply. From this chart, we see really substantial differences in spending behavior between households that lost income and the households that didn't. The first point that I want to highlight on this chart is that households that lost income were much less likely to rely on regular income than the households that didn't. So if we look at these two bars on the far left, 76% of households who didn't lose income continued to use regular income sources to pay for necessities. But only 44% of households that lost income reported using regular income still. This finding is very intuitive. It shows that regular income is a very common way that households pay for necessities when they haven't taken a financial hit. And it shows that households that lost wages were much less able to rely on that resource during the pandemic. As a consequence of not having as much income available to them, the households that lost income were much more likely to rely on every other financial resource. They were more likely to take out credit cards or to take out loans or use credit cards. For example, looking at the far left in the highlighted area, we can see that 24% of households that didn't lose income used credit cards and loans to pay for necessities, but 36% of households that lost income were using credit cards. Households that lost income were also more likely to tap into their own savings or to sell assets, and they were more likely to borrow from friends or family. Households that lost income were also more likely to use policy supports. Intuitively, they used unemployment insurance at a very high rate, and they were also more likely than households that didn't lose income to use stimulus checks, money saved from deferred or forgiven payments, and SNAP benefits to pay for their ongoing expenses. So far, we've reviewed differences between households who took a financial hit and those who didn't. Next, we're going to focus specifically on that over half of renter households who lost income, and we're going to see how resource use differs between the households who lost income but were able to stay current on rent, even after that financial hit, and the households who lost income but fell behind. The ability to tap other financial resources clearly was very instrumental in helping renters avoid falling behind on rent. And we know this since only about a quarter of those that lost income actually fell behind on rent at the time of the survey. So looking at these different types of resources that households are turning to, and the households who fell behind on rent in particular is really instructive. The sample in this chart is limited only to renters that lost income, and the blue bars in this chart represent households who are not behind on rent, and the orange bars represent the households who did fall behind on rent. There are a few things I want to draw your attention to in this chart. The first being the bars highlighted on the left. From these bars, we can see that households that weren't behind on rent were much more likely and more able to draw from their own personal financial resources. Half of these households that lost income but were still current on rent still had regular income to draw from. They were also using credit cards and savings at slightly higher rates than the households that fell behind. We think this may be related to the fact that households that stayed current also had more resources available to them to begin with, although that's not something we can actually see from this data. For those who are behind on rent, though, they had less regular income and formal sources to rely on, and they're really pulling from a different set of resources. So really notably, half of households who lost income and fell behind on rent during the pandemic were borrowing from friends and family. Borrowing from friends and family was actually the most common support for these households. A higher share reported borrowing than reported using any other resource. These households that were behind on rent were also significantly more likely to use SNAP to meet their spending needs. 28% of households that fell behind reported using SNAP, double the share of households who were able to remain current on their rent. And this really points to the different types of resources that they have available to them. Now, in order to fully understand the resource use and the differential resource use for households who are behind on rent, it's really instructive to look at demographic differences between households. This chart shows resource use among households behind on rent. It's measuring the share of households at each income level that are using each resource. The major takeaway from this chart is that higher income households have more resources available to them. So even when they fall behind on rent, they're more able to rely on their own financial resources. So let's take a look at the regular income category that's on the far left. More than a third of households with incomes above $75,000 who were behind on rent reported using regular income for their spending needs. And this ability to use regular income diminishes for lower income households. The higher income households were much more likely to use money from credit cards and savings, probably because they were more likely to have these resources to begin with. Higher income households were also more likely to use money from deferred payments, possibly relating to the fact that they had higher rates of college education and were therefore more likely to have student loan debt. While higher income renters were also more able to rely on these formal financial resources when they lost rent, lower income households weren't. Borrowing from friends and family stood out as a critical resource for lower income households. 57% of households earning less than $25,000 borrowed from their friends or family. The fact that borrowing rates were so high really suggests that there may be financial ripple effects beyond those households that stretch into their community and into their immediate social networks. And SNAP was a really widely used resource too, with 37% of lower income households using SNAP to pay for expenses. The difference in SNAP use isn't very surprising since it has eligibility requirements based on income. But the fact that it's the second most commonly used resource among lowest income households also points to the fact that those households had very few resources to turn to. And as a result, SNAP was a really important support for them. The trends by race and ethnicity were in some ways pretty similar to household income. Black and Hispanic households in particular have lower incomes on average, resulting from decades of discrimination in the labor market and in education. Given this overlap in race and ethnicity and income, the spending strategies for Black and Hispanic households in particular generally look a lot like the spending patterns by income. We also see that Black, Hispanic, and Asian households were less likely than white households to rely on regular income or savings. These rates of using credit cards or savings were particularly low for Black households. Asian households also turned to credit cards much more so than other households did, but were less likely to borrow. We don't have a particularly great explanation for all of the differences in these spending strategies. So maybe that's something that one of you in the audience has some insight into. But we do observe that all households, Black households, Hispanic, Asian, and white households, were all who were behind on rent, we're all relying on stimulus checks and deferred loans at pretty similar rates. Now, the descriptive statistics that we've presented are really useful. But as we've seen, there are also really substantial demographic differences between the households that lost income, the households that fell behind on rent. The purpose of the models I'm going to present is to test the independent association of household characteristics, as well as the use of different resources on the likelihood that a household falls behind on rent. So far in this talk, the only household characteristics I've been able to cover are income and race and ethnicity. But in the paper, we do look at a much wider array of household characteristics. And this includes the presence of children, at the educational attainment of a household, as well as the type of building that a household lives in. In this chart, we see that the x-axis is measuring odds ratios. An odds ratio of 1 means that there's no independent association between the demographic characteristic and the likelihood of falling behind on rent. A ratio greater than 1 means that the characteristic is more associated with a missed payment, and a ratio less than 1 means the characteristic is less associated with a missed payment. The demographic components of this model generally confirm the cross tabulations discussed in previous slides. Among the households who lost income, Black and Asian renters were nearly twice as likely as white households to be behind on rent payments, even after taking into account income, education, and family composition. The presence of kids in the household was also associated with much higher odds of missing rent than households without kids. And finally, households with income in the lowest 2 categories were also much more likely to miss rent, as were those who only had a college diploma or less. The model also confirms that the financial strategies highlighted in the cross tabulations. Using regular income significantly reduced the likelihood of missing a rent payment by nearly half. Savings and assets also provided a buffer for households who lost income, and it reduced the odds of missing rent by 16%. Borrowing from friends and family, on the other hand, was associated with twice the likelihood of being behind on rent. This likely reflects having fewer resources to draw on. SNAP benefits were also associated with a higher likelihood of being behind on rent, and maybe capturing household financial shortfalls. Now, there are a number of important policy implications from this research, and I'm going to go over just a few of them. First of all, our findings point to the importance of ongoing federal aid for households who've taken a financial hit. Federal aid, including SNAP, stimulus payments, and unemployment insurance, remain really critical pillars of support, particularly for lowest income households. At the same time, we also know that extremely low-income households who received these public supports still tapped their own very limited financial resources and still borrowed from friends and family, which suggests that these federal programs by themselves may not be fully meeting the needs of these very low-income households. Another important implication is that 3/4 of renter households who lost income but did not fall behind on rent, for these households, the financial impact still includes a loss of savings and higher levels of debt. And this points to the need for financial supports that go beyond emergency rental assistance and address the pandemic's impact even on the households who are still able to make rent. And finally, we've observed that low-income renters who took a financial hit were more likely to borrow from family and friends. This points to the radiating of the financial impacts of the pandemic beyond those directly impacted, The financial hit isn't just impacting lower households who fall behind, but it's impacting their communities and their social networks too. And this is another way that the costs of the pandemic are really being underestimated. I'll close by saying that there's a lot of areas where we really just need better data. A lot of the indicators we've been relying on don't tell us the magnitude of these problems. We don't have a great estimate for how much income was lost, how far behind households are, or how much of their savings they bid into paying for rent. We also lack a complete, up-to-date national data set on evictions or repayment plans with landlords. Because eviction is one of the most severe consequences of losing income for renters, it really does deserve our attention, and it's something that we really need to be able to monitor. And then finally, we also need data that's disaggregated by household characteristics, including and particularly race and ethnicity. The pandemic has had really unequal financial impacts. So the more that we can disaggregate housing data, the more we can measure those disparities and target policy supports where they're most needed. And with that, I'm going to turn this back over to David and welcome him back to the conversation, and we're going to take some questions. Thank you.
Thank you, Sophia. Really, I think there's some of this, I think, confirms our intuitions, but I think there's also some really interesting and important insights in here. One question that's actually come up a bunch in the Q&A, and I do want to point people that several questions have come up in the Q&A that some of the paper's co-authors have been answering, and so I encourage folks to look at that, and I may pull some of those out for broader discussion as well. But one question that has come up from several places or several attendees is, how do we think about rental assistance programs in this? Doesn't appear to be any category in the varying charts that separated that out. So I'm just wondering, do we have any sense from the data and the time frame you're looking at how important the rental assistance programs have been?
Sure. Yeah. So, we know that, rental assistance is clearly critical because households are tapping into, because they're sort of turning to savings and they're turning to borrowing and they're turning to other public supports that are sort of COVID era policies like unemployment insurance, but mainly the stimulus checks. We really know that cash assistance is needed. I would say I think that it's also limited in a sense in that because the emergency rental assistance, because one of the eligibility requirements for emergency rental assistance is that households fall below a certain income threshold. I would say that a limitation there is that it's potentially missing the small but significant share of higher income households who are also experiencing financial distress and who are also behind on their rent. So we would say it is very important. It's also something that following our study period, the Household Pulse Survey has started asking households about. So it's something that we're looking into and we'll hopefully have more data on. And then last, about emergency rental assistance, I would say, yes, it is critical, but it also depends on, it needs to be administered and distributed quickly. We know that there have been lots of issues, particularly like a lot of statewide disparities and even county level disparities and how quickly rental assistance is getting out. So we know that it is critical and it's also really important that it's delivered quickly.
There was a question about whether in any way you or your colleagues disaggregated some of this data at the state level. And you recently wrote a blog that I may not be part of the paper, but I know you recently wrote a blog about state level variations. And I'm wondering what you can say about it. And partly I was intrigued by that question because in one of the charts you showed, folks in manufactured housing seem quite much more likely to be behind on payments. And it strikes me that manufactured housing is more common in certain parts of the country in certain states than in others. So is there anything you can say about state level variation and anything more on the manufactured housing?
Absolutely. Yeah. So, I think two major takeaways there. One being that the states that had the most income loss for renters were really not the same states where renters were disproportionately falling behind on rent at the highest rates. So that the states where renters were most likely to be behind, I think were Mississippi, Alabama, Georgia, two others, but it was essentially, it was states with really high shares of Black households and really high share of low income households. And I think that really kind of highlights that a lot of this can be understood in terms of demographic disparity and in particular racial disparity. Some of that also has to do with the timing of shutdowns and where the pandemic was most devastating. For example, we know that really low shares of households were losing income and falling behind on rent in the Dakotas, on the West Coast, in some of the states that had less stringent and really less proactive shutdowns of economic activity. But the main point with the geographic variation in who's impacted is that has a lot to do with the states that had the highest housing cost burdens going into the pandemic and the states where renters were already very vulnerable.
You may have, I don't think you touched on this, but I might have missed it. Can you say anything about variations by age? And in particularly thinking about older households who on the one hand are more likely to have been on already on some sort of consistent income stream, but also might have been more vulnerable to the disease and costs related to it.
Sure. So, I mean, we know from the household pulse survey data, because we did look at age, that it actually appeared that the youngest households and the oldest households were in some ways faring better in terms of having like relatively lower rates of falling behind on rent. There's a lot of sort of push-pull factors here, so it's kind of hard to tell what exactly is going on. Although I will say that, I mean, lower income households of any age group are really getting the worst of this. So I would hypothesize that a lot of that probably has to do with income, and also the fact that working age adults were more likely to lose wages, and that people working in certain service industry jobs are more likely to lose wages. So it might be related to that. When we looked at the degree to which households were behind on rent by age, our focus was on households age 65 plus. It might be true that if we stratified among older age groups, we would see like even further disparities, because the evidence generally points to the fact that households, for example, over age 85 tend to have higher housing cost burdens. But that also that depends on other factors too. But we definitely saw differential impacts by age.
Is it possible that there's a connection between age of household? Your finding, I thought, on households with children is both striking and if you think about it for about 8 seconds, you can begin to understand why. But it occurs to me that the youngest households and the oldest households are probably also least likely to be the households with children. Is that? I'm speculating, but and I don't know if there was anything more that came out particularly of that in those findings about either the numbers or ages of the children, for example.
We didn't look at the number or the age of children, just the presence of children. And that alone was pretty striking, because households with children were around twice as likely to be behind on rent as households without children, obviously not looking at the potential, like the other factors that might interact with that. But on its own, I mean, we know that childcare costs are extremely high, and that households with children tend to be more cost burdened to begin with anyway, holding other factors constant. So it's not very surprising that that households with children were more likely to be behind, and also that I guess that older adults that don't have young children in the households might also be like less burdened as a result of that.
Just pushing on that for a second, and again, I don't think you at least showed this. Is there a significant differences if you think about households that are single parent households, 2 adult households, and then and perhaps multi-generational households?
So we didn't look at multi-generational households, but we did break this down at one point by household composition. And from my memory, I'm pretty sure that single parent households had very high rates of falling behind on rent and losing income. I think the other point would be that household composition on its own isn't really telling us everything, especially because, I mean, there's so many other factors, including income, where that could either be an asset for a household or a detriment. And so that's something that I think would really benefit from the multivariate analysis we ran, which we only ran by comparing households with children and households without children.
I was really struck by the, I think the line you used was radiating financial impacts, right? I think this is actually one of the most important findings out of the work, that if we only look at rental arrearages, we may miss a bunch of damage behind the scenes. And then I was thinking about if in fact we think that that's a concern, what, I don't know if you and your co-authors have been speculating on what a policy intervention might look like that takes that into account. How would we actually go spitballing here?
Yeah, so I think, thank you for bringing that up, because I think that is like a really interesting point that we've been thinking about a lot that I think deserves more attention. And I think the good news here is actually that ERA 1 and ERA 2, both of the emergency rental assistance programs, have as part of their eligibility criteria that households list or basically attest that they lost income either, or that they took a financial hit, some sort of hardship, either directly or indirectly related to the pandemic. So, which is, I think, a break from a lot of past federal policies that might ask for proof of unemployment insurance, for example, or a note from a boss saying that the employee lost wages or was laid off. So the good news is that at the very least, emergency rental assistance would theoretically, if a household lost income because they were giving income to a friend or a family member who is in dire financial straits, that household would potentially qualify for emergency rental assistance, assuming they met the other criteria. Mm-hmm. But I mean, with that being said, I mean, we don't, if the households don't also meet the other criteria, they're not, and in particular, if they're not facing housing instability themselves, they of course wouldn't qualify for emergency rental assistance. So I think one of our big takeaways there is that kind of like the households who were able to keep up with rent, but who did so by, for example, depleting their savings, this is kind of another way that we're underestimating financial costs. And I don't really know what the policy solution would look like, but it's pretty clear that those households, need to replace that cash somehow, and we don't really know how they're going to do that. And the other thing I'll say about that is, in terms of the radiating financial impacts, when we think about the fact that lower income households were the most likely to borrow, and that people's social networks tend to be very similar to them, their friends and family, it seems from what we know, and there's no survey question on this, it's probably very likely that lower income households were borrowing from other lower income households. Just thinking about the proximity of people to their social networks. So that really is a cause for concern, and also something that policy should target. And I think, if we could add one question to the household pulse survey, I think in addition to have you borrowed from friends or family, we would probably also want to see, have you given money to friends or family? Because that's another way that financial stress is really being underestimated.
Mm-hmm. Mm-hmm. Interesting. I found myself thinking about, we just published a Joint Center blog, I think it was yesterday, on some alternative ways to certify income that they've been trying in Colorado. A really interesting piece by Sam Gilman, who had been one of our summer fellows. And that relied on essentially, is this a low-income neighborhood, and which metrics might you use? Which seems like it might, at least in a rough way, get at getting money out into the communities that where it's probably going to do the most good.
Right. Yeah. I mean, it's definitely true that one of the tools that Treasury is encouraging is that when states are delivering rental assistance, they do target it to the households that need it most, and they have a lot of proxies for that. Like, as you said, the neighborhood income levels. I think that's an excellent idea. And I would just add to that we need more information about who is giving this money, because we know that they are. And that's another way that this financial stress is being estimated. So it's a really important thing to keep track of.
Interesting question just came in about whether we are or are thinking of trying to trace the long-term economic impacts. And I guess one of the problems of the pulse is it's a snapshot in time, so we're not actually getting to follow households. And I'm wondering if I certainly don't know of us doing any work like this, but I don't know if there's been any discussion or if you know of any research that's been trying to follow a long time, or if you were to think about that work, what would sort of be the big questions that you might go into that work with?
Yeah, I mean, that's a really great question. So just to clarify, David, I mean, as you said, the household pulse survey is not longitudinal, and it's an independently drawn sample every time. So we're not tracking the same households over time. I think that if we had that data, I think it would be very instructive. One thing you probably noticed about the time period we selected from August 2020 through March 2021 is that was really before a lot of the federal policies that were meant to support renters. So the two emergency rental assistance programs really came through and started distributing aid. So I think it would be very instructive to be able to track how households were doing after those policies came into effect. And we do have some evidence, I mean, even from the Pulse survey, that policies really are making a difference kind of in real time in a way we can track. So for example, the share of households that reported using stimulus checks to meet their spending needs has two jumps in it when the stimulus, like shortly after the stimulus checks were distributed. So we know that even with this like independently drawn sample, there is some evidence of that. But it would be really, really important, I think, to be able to follow the same group of households over time, because one of the things we're really concluding is that the households who are behind on rent are really turning to sort of measures of last resort when they're borrowing from friends and family, and very low rates of using their own income and their own savings. So we're really interested, and I would say also very concerned to see what happens next. Particularly with those households who seem like they have exhausted most of their own resources. And if they're in a place that doesn't have a local eviction moratoria, I mean, they could potentially be at risk of eviction. So that's definitely something that we want to keep our eye on.
There just on the eviction question, there was a question about whether we knew anything about the ownership of the units that people live in. Particularly, you had some interesting findings, I thought, about just the size, the kinds of properties. I'm assuming that the data doesn't tell us whether you're in a public entity, an entity owned by public housing, a nonprofit or a for-profit landlord, but I figure I'll check.
I don't think that's certainly not something that we looked at. I would say if you're interested in information on property ownership in general, you should probably look at Elijah De La Campa's paper on landlords, because I think that does also get at not just rent collections, but also kind of the impacts of the pandemic on tenants in different types of buildings. So I would definitely refer you to that work. Although no, we did not track public versus private. Although we can kind of assume that households living in subsidized housing probably did have higher cost burdens, and certainly were more likely to lose wages if they're lower income, as the data suggests.
There's a question about. There's actually been a couple of questions about this idea of multiple spending sources, and I think it's really quite striking. I was really struck by the relative evenness of a number of the sources. But do we know anything about whether people are are people tapping one, two, what's the distribution of the different kinds of things people tap?
Sure, yeah. So we know a little bit about that. I'll go forward a few slides and see if I have something in the vault that might be interesting. Yeah, so we looked at spending sources and combinations of resources in quite a bit of detail. This slide is really getting at households who are behind on rent, who are using, and how many spending sources they were using outside of and apart from their regular income and SNAP, because in this case, we treat SNAP pretty similarly to income. And what we see from this is that the bulk of households who lost income, whether they were behind on rent or not behind on rent, we're using at least a few sources. We're using at least one or two resources to pay for expenses. We also see that looks like that in the 20s, 23%, 26% who are behind on rent were using 3 or 4 resources. So pretty high rates of households using multiple resources, very relatively few households just relying on regular income or just relying on any one source. And I'll also say that that's something that we looked at in a lot more detail in the paper, and obviously didn't have time to go into now, but it's something that we're definitely thinking about. And there's a lot of additional analysis on that front.
Are there particular combinations of spending in that sort of huge kind of, what color should we call that, burnt orange? You know, particular combinations that were common, or is it really a little bit of everything?
I mean, it's a little bit of everything. Most households continue to use regular income. I think that was the most common, like regular income plus something else. We also know that in general, most households were using a combination of their own personal resources and public sources. So those were pretty popular combinations. There are 8 resources that households can use, and it's a very long list. So that's something else that we're working to disentangle and figure out, you know, which combinations are the most fruitful. But I think that is also something we've been able to answer fairly well descriptively, even without looking at combinations, because we know, for example, that if households aren't using regular income, you know, they're using something else, and that we can tell just from the percentages that households are using multiple sources in some cases. For example, if, you know, I mean, a household can't just use SNAP because it's very little money. So we know that, or stimulus checks, which come and go. So we know that they're combining sources. And also going back to the Logent models very briefly, we also know that regular income is like very well associated with making rent, and borrowing from friends and family and using SNAP is associated more with missing rent. So that is something that we're thinking about, these spending combinations.
Your answer is actually, there are 2 things that a couple of people have just asked in the Q&A whether the slide deck is going to be available.
Yes.
And just to remind folks, the slide deck will be posted, and we'll also post a video that takes us a couple days because we got to get it captioned. But those will both be available on our website. There was a question just related to this about the pecking order of funding sources used. Do we have any sense as to kind of where do people sort of turned first and most, I guess, would be the 2 questions we'd have in pecking order?
Yeah, I mean, so that's something we get at a little bit in our analysis of spending combinations, but I think it's also something that we get at in the initial comparison of households that lost income and households that didn't lose income. Because we know that around 76%, I believe, of households that didn't lose any income were still relying on their regular income sources like those received before the pandemic. So in a way, we kind of treat those households like a baseline for what we might expect households to be doing normally, or at the very least, if they haven't had a substantial financial hit. And obviously, there's a lot of stratification there, particularly within income levels of the household. But yeah, regular income and then savings were also and credit cards were all pretty commonly used. We saw with those households that stimulus checks were used too, but we're assuming because there were fairly similar rates of households who lost income and households who didn't lose income using stimulus checks, that for a lot of households that was probably just out of opportunity. And not something that they're typically doing, obviously. But certainly, yeah, regular income was far and away the most commonly used resource for households who didn't take a financial hit during the pandemic.
Yeah. I mean,
that. Yeah.
That made me wonder if that kind of hiding in that is also the question we've not been able to answer, you've not been able to answer about magnitude, right? So households that lost some income could be using income for spending. That obviously, the more income you lost, the less you can use that for spending. Let me wrap up with sort of two or kind of a double question here, which is, as you went into this, you had certain expectations. So one question is, was there a finding for you that was just particularly surprising? And also, kind of as you have been through this, what if you had kind of one big question that when we go to the third version of the iteration of this work that you'd really like to try and answer, even if you can sort of just make up that you'll have the data source. So what was the big surprise, and what for you is the big question that comes
Yeah.
next?
So the big surprise is that over half of households that lost income and were behind on rent were using borrowing from friends and family to pay for expenses. This was, I can share that slide again, but it was, or you can watch this presentation later and find out for yourself. It might take a minute for me to get to it. But that was really, really shocking because borrowing was just, it was the most common thing that households turned to when they lost income. They were more likely to borrow than to tap into any other of the 8 resources, any of the 7 other resources, which we think is just extremely unusual and also very indicative of like the really sort of dire financial straits that these households were in, that they weren't able to tap into what we think of as their sort of traditional or like formal means of support, savings, credit cards, et cetera. And also that the federal programs weren't necessarily reaching them. So that's, I think that is something that we'd want to study further. And I think in particular, I would be very interested, I don't know how we would do this, but I'd be very interested in getting at the radiating financial impacts of the pandemic and really exploring more about how this is affecting people's social networks. We know that rent arrears, when you look at them, there's really big differences between neighborhoods. And I think a lot of that might be related to just segregation by income and the fact that if a lot of people lost income or a lot of lower income households are like living in one neighborhood and then they all lost income, they're all turning to X sources instead of Y sources. But it would also be interesting to see like how much of this is or how much kind of segregation in terms of the resource use is related to that. So I would definitely be interested in examining like what the effects, what the consequences are of all of this borrowing from social networks, assuming again that it's probably lower income households borrowing from other lower income households.
Yeah, I have to say, I think that the earlier paper, I think one of the things that was most striking was the importance of thinking more broadly about all the kinds of ways that we could assist renters, particularly, I think, the importance of SNAP. Not that people can use SNAP to pay rent, but they can use SNAP to pay for food, and then that frees up, they don't have to make that rent eats first judgment. I think that this work really focusing on these radiating networks and also really showing the incredible importance of the aid that we've provided and likely the need for at least some continuation of that. I want to thank you for, I thought that was an extraordinarily clear presentation. I really loved just the way you kind of helped those of us who don't, haven't been living in this research sort of go through it. And I appreciate, your ability to swat at all the softballs and flaming softballs that got thrown at you. I think this is really important work. I'm really glad that the center is doing it, and you and my other colleagues are at it. So thank you. In many respects, this conversation continues in 3 weeks. I think that the work that Sharon Cornelissen and Alex Hermann are going to be presenting on COVID's economic impacts really builds on what Sophia's been talking about. I look forward to seeing your names in the list of participants. Sophia, thank you very much for a terrific presentation.
Thank you.